depends on how you want to look at the global universe. I mean, you can go by what's different countries' share of the economy, what's their share of the stock market or global indexes. We look at this a lot. We looked at it maybe 6-9 months ago and took a deeper dive again into whether or not we want to make any changes. And I think you can make an argument for anywhere from, let's say, 20% international up to, you could probably make an argument for 75% international. Personally, we don't go that high. We range, let's say, from 15-20% international to about 40% international within our overall portfolios. Which really, the truth of the matter is, it leaves us overweight on the U.S. if you look at most kind of global benchmarks. The reason is that most of our clients live in the United States. They spend their money in the United States. So there's that home bias, kind of makes sense. And the other thing is that people in general are a little bit less comfortable with international investments, and the more comfortable you are with your portfolio, the more likely you are to be able to stay with it. Obviously, that's the job of us as financial advisors, but if you're doing this on your own, you want to make sure it's a portfolio you can be comfortable with. So if you start to tilt much beyond, let's call it 40% international, you might start to see so much divergence from the S&P or the Dow that you're seeing every day that you can't kind of stay the course.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.